concept when it comes to real estate and accounting for real estate transactions. And the concept that we're going to be discussing today is depreciation recapture. And again, I mentioned this isn't a very straightforward concept, and a lot of individuals that I interact with that are real estate investors are not aware of the process and the concept. So what I want to do with this conversation today is to highlight some basics as it relates to the depreciation recapture and some things that you should be considering and looking out for so that you can ultimately reduce the negative impact that it could cause to you. So again, welcome to all that are joining, and to those that are new to me, my name is Jamel Nelson, and I'm the owner and founder of Nelson and Associates, where we are a CPA firm that specializes in accounting for real estate investors. So as I mentioned, today's topic is depreciation recapture. And the reason this is the topic today is because the problem that I've identified in interacting with some clients is that they may not be aware of this thing called depreciation recapture. And depreciation recapture is a process in which you are taxed on a sale of an investment property. So to really understand how that works, I think it's really important to understand who this impacts and why it impacts this individual. So I think most of you all should be aware of the concept of depreciation. And depreciation is pretty much the concept of a valuable asset depreciating or losing value over the course of time. And this is due to normal wear and tear and deterioration of that asset. So for depreciation expense, it is a similar concept when we look at a real estate investment. If you have a real estate building or capital assets attached to this real estate building, we're in a position where we are to experience and apply depreciation. And there's a difference between depreciation over a residential property and depreciation over a commercial property. When we depreciate for a residential property, that depreciation is typically standard going to get depreciated over a 27.5-year period. And then when we look at the depreciation of a commercial property, that commercial property is going to get depreciated over 39 periods. So just keep in mind that there's two different scenarios if we take the traditional approach of depreciation. So depreciation recapture. Ultimately, if you have real estate investments, you're in a position where you can maximize your tax scenario because you can then take what we call depreciation expense, which ultimately is going to allow you to take paper losses or phantom losses to reduce your taxable income. And many investors are aware of this benefit, which is primarily why they get into real estate so that they can offset their taxable income. However, one thing that a lot of these investors may not be aware of is the fact that once you sell an investment property, you actually have to account for all of the depreciation that you previously took advantage of. And now you're in a position where you actually have to pay tax on it. And paying tax on this depreciation is very, very important because if you're in a situation where you're planning on making a sale and you're not aware of this potential tax, this could result in tens of thousands, if not six-figure tax bills that you were not expecting. So this concept is really, really important because if you're in a situation where you're actively involved in real estate investing and you may have sales or sale properties, this is for sure guaranteed going to impact you. So when it comes to depreciation recapture, this is when you sell your real estate that is actually real property and considered real property, and you're on the hook for paying tax on any of the previous depreciation that you took. Now, one thing that I want to make very clear when it comes to depreciation, it is not an option for you to elect to take it or not to elect to take it. You actually are required to take depreciation. And if you do not report depreciation on your tax return and you do ultimately sell the property, The fact that you didn't take the depreciation doesn't give you a get out of jail free card that you can avoid this possible tax. Instead, what the IRS does is they say, even if you didn't take this depreciation recapture expense, or if you didn't take expense in previous periods, we're still going to tax you because you should have. So when it comes to depreciation expense on your rental properties, it is a requirement. Even if you didn't record it or report it, it will get factored into this calculation. So for depreciation recapture, there's three major types of recapture. And the first type is considered your Section 1245. This is the first type of recapture, and this relates to capital assets. So anything that is attached to the real property, this is where we're going to talk about 1245 recapture. You also have 1250 recapture. This is also related to your capital assets. And then the last one is the unrecaptured 1250 gain. This is the type of recapture that's related to the actual building or actual real estate that's not the capital asset, but the building itself. So with these three types of recapture, it's important to really understand what they are and how they work, because ultimately this is going to impact or detail how much of the tax you're on the hook for. So for the first example, which is the Section 1245 recapture, this is actually going to get taxed up to your ordinary tax. So this is important because we're not going to factor this in as it relates to capital gains taxes, but whatever your tax bracket is and wherever you fall on the tax bracket, this is how you are judged on what the tax is there. So once you figure out what your ordinary tax rate is, we then need to apply what the actual gain of the sale was. So let's take a step back. The only time we're considering and concerned with the depreciation recapture is if you actually sell the property. If you don't sell the property, then this is something that will just continue to sit in the background. But as soon as you sell this investment property, now this is going to trigger one of these three events. So when it comes to the Section 1245 scenario, this is a case in which you sell the property, and now after we sell the property, we now need to take a look at what the actual potential is for our recapture. And I'm going to give you guys an example. So let's say that you're a real estate investor and you own a property that's worth $1 million. And that property has taken $300,000 of depreciation up to this point. So if we need to identify what the adjusted basis is on this property, what we're going to do is we're going to subtract the 1 million from the 300,000 depreciation already taken. That's going to give us an actual basis of $700,000 of what this property is actually worth on paper. Now, let's say the same owner decides that they're going to sell because we're living in we're in a hot market right now, and they want to capitalize on the potential to make a gain. So they sell this property for $1.5 million. And what that means is if they sold the property for $1.5 million, we now need to compare that against what the adjusted basis is of $700,000. So 1.5 million sale price minus the 700,000 adjusted basis, it's going to give us a scenario in which we have $800,000 to account for. So of that $800,000 gain, we now need to factor in the $300,000 depreciation that we previously took. So this is the portion that we now need to assign and allocate to the 1245. And that $300,000 is what we now will factor into your tax table and determine where you fit on the tax table to identify your ordinary tax rate. So that's the first example of what a 1245 recapture is. The second example is what we call Section 1250. And this is related again to capital assets. With the Section 1250, this is ultimately identifying the additional depreciation that you took as a result of doing something such as a cost segregation or a bonus depreciation. We need to identify what you expedited and front-loaded versus what you should have taken if you were to depreciate the asset over the normal course of a straight line period. So what this means is, for example, let's say we have a parking lot that we established on the property. That parking lot actually cost us $30,000 to build up. Now, let's say that the parking lot is going to have a useful life of 15 years. If we were to do a straight line depreciation method over this $30,000 parking lot, we're going to take that $30,000 and divide it by 15 years. That gives us $2,000 of depreciation expense that we can actually recognize over the course of the 15 years. And this is using the straight line method. However, if we decided that we were going to do a cost segregation study and bonus depreciate this parking lot, instead of taking $2,000 depreciation expense over the course of 15 years, we're actually going to take all $30,000 depreciation expense in the first year. So if we do that, and then let's say we fast forward 5 years later down the line, and we make a sale, we've already depreciated and accounted for the entire $30,000 property by way of the bonus depreciation. But if we were to actually do the straight line and we sold the property at the 5-year mark, the straight line should have been $10,000 expense over a 5-year period versus the $30,000 expense in the first year. So there's a difference, a variance between that $30,000 and that $10,000, which is the $20,000. We're now on the hook for being taxed on that recapture of $20,000. So that's the example of your 1250 recapture. And then the last one is your unrecaptured 1250 gain. With the unrecaptured 1250 gain, what this does is it is now going to focus on your actual building itself. Whereas the previous two examples were more of the capital items, this is the actual building itself. So ultimately, anytime you sell a building, you're going to be on the hook for this recapture. And the difference between this from the other two previous examples that I shared with you is that the maximum that you can actually get taxed is the 25%. It's not going to be based on the maximum ordinary tax rate of 37%. And then we also have to factor in the details to calculate your actual ordinary tax versus capital gains. So these are the three type of depreciation recaptures. And ultimately, if you're a real estate investor and you're going to sell your property, this is for sure going to be something you need to be aware of, because this is going to impact how much tax you're on the hook for. So one strategy that I think is an important strategy to either not necessarily avoid, but we can defer and delay some of these taxes. And again, anytime there's a sale, there's no getting around it. You're going to have to pay the taxes on this recapture. But one thing a lot of the savvy investors will do is they will employ a few strategies and tactics. And one key strategy that they will use is a 1031 exchange. And the benefit of a 1031 exchange is that it's going to allow that investor to defer any capital gains taxes or any deferred or any recaptured taxes into a future period. And the benefit of the 1031, you can continue to do this repeatedly and eventually not necessarily sell the property at any point. But if you continue to defer these taxes, this could affect, allow you to bypass the immediate need to be on the hook for these taxes. Another scenario or strategy that you can utilize or employ to reduce this impact is if you were to actually sell the property and you're on the hook for the taxes, in that same year, if you were to go out and purchase another property and you actually implement a cost segregation or a bonus depreciation on that new property, you can effectively take losses by way of the accelerated depreciation, and those losses from the newly purchased property can actually offset the gains from the old property that was sold. So that's another scenario in which you can actually reduce or decrease the burden of the recaptured depreciation. So